Hey everybody, I'm Rob Freeman and welcome back to Insuring the Built Environment. This week we're answering a question about the difference between a deductible and a self-insured retention. And many people are familiar with the term of a deductible or concept of deductible in an insurance policy, but they haven't heard or seen the concept of a self-insured retention. In both cases, a self-insured retention and a deductible are designed to do something similar, which is to get the insured and the insurer on the same page and get the insured to have some skin in the game to be responsible for a portion of any claims that would be submitted to the insurance carrier to be processed. But there are several differences between a deductible and a self-insured retention, and we're going to talk about 5 of those specifically here. So the first one is the timing and whether the insured comes out of pocket for the first dollar or whether they are reimbursed or whether they reimburse the insurance carrier. So in a deductible, the insured will typically reimburse the insurance carrier in the event of a claim. And so the first dollar of their insurance coverage is paid by the insurer, but in the event that the insured has, say, a $50,000 deductible, after the insurance carrier has paid that $50,000 or whatever the amount is, the insured is going to reimburse the insurance carrier for that $50,000 deductible. Now, with a self-insured retention, the insured is actually going to be coming out of pocket that first $50,000, and the insurance company is not even going to get involved until the self-insured retention is paid in full. And so that brings us to the second difference, number 2, in terms of these differences. Number 2 is erosion. And as I mentioned in number 1, a deductible is reimbursed and a self-insured retention is paid out of pocket. So when an insurance policy has a self-insured retention, that money that is paid out of pocket does not erode the policy limits that the insured has. So if you have $1 million insurance policy and you have a self-insured retention for $50,000, you're going to come out of pocket that first $50,000, but then the insurance company is going to give you another $1 million of insurance coverage, where with a deductible, you will be responsible for reimbursing that $50,000 that the insurance company is going to pay. But then the insurance company is only going to give you an additional $950,000. So if you have a $50,000 deductible and the insurance company gives you $1 million of coverage, after you reimburse that $50,000, you're only going to have a $950,000 left in terms of your coverage there. Okay, so the third thing is defense costs. In a deductible, the defense costs are typically added, or they're included in the cost of the deductible. That they can be commingled in terms of those expenses. But in a larger deductible situation, say if you have a $100,000, $250,000 deductible, the defense cost may be a separate item that you may be responsible for, or they may erode the deductible in terms of how much the insurance carrier recognizes that you've paid. They could be a separate limit or they could be included in the deductible. Whereas with a self-insured retention, that's not really the case. It's not really an issue because the insured is going to be responsible for every penny of that self-insured retention up until it's been used up, and then the insurance company is going to kick in. Okay, the fourth thing is what's known as collateral. And if you've ever heard of putting up collateral for a loan or providing some sort of a credit enhancement if you're borrowing money, well, in this case, the insurance company is getting some credit risk where they are agreeing to provide a insurance policy for a large deductible. And in this case, the insurance company, maybe if they're providing $250,000 or $500,000 or $1 million deductible on a large insurance policy, they may require that the insured provides them with a letter of credit or some other proof of collateral that they can pay back. They can reimburse that deductible to the insurance company in the event of a large claim. Now, with a self-insured retention, that's not an issue because, again, there's no risk to the insurance company because they're not going to come out of pocket anything until that SIR is used up. Okay, and the fifth thing, number 5, is for certificates of insurance, what needs to be disclosed, whether you have a deductible or a self-insured retention. If you have a deductible, you typically don't have to disclose the amount of the deductible on the certificate of insurance, the COI, but with an SIR, with self-insured retention, because your insurance is not going to kick in until you have used up that SIR, it may be required that you provide disclosure of that SIR to a certificate holder, such as a lender or a bank, that you have that SIR in place and that you're going to be essentially the insurer up until that amount has been paid and used up. So those are the 5 things that differentiate a deductible from a self-insured retention. If you have questions about this or other insurance issues, or you're looking to talk to an insurance broker who understands what you do, feel free to schedule an appointment with me at the link below. And thanks again. Hope this is helpful, and have a great day.